This is level 1 of the CFA program, the topic on alternative investments and the reading on Introduction to Alternative Investments. This is a relatively new reading written by 5 professionals who hold the CFA designation, but one of the individuals holds the CAIA designation. And I went to the Chartered Alternative Investments Analysts webpage, and this is what I discovered, is that designation requires lots of breadth and lots of depth. As I compared that to what we see in this reading, we're going to have lots of breadth, but not too much depth. And that's why I guess it's called an introduction. One other interesting note is that I found this reading to be super well written. I had the thought with 5 authors it might be kind of disorganized, but it really was not. And I really enjoyed the first couple of paragraphs where the authors describe this concept of alternative investments by reminding all of us that the traditional investments include things like stocks and bonds and money market instruments, of course, and that there's a whole universe out there that provides some type of investment vehicles that don't fit into the traditional category. The authors are quick to point out that alternative investments are neither rare nor new. There are tons of these things out there, as you'll see working through the slide deck, but they're not new at all because they include things like real estate, which goes back to, I don't know, when was the earth created? 5 billion years ago. And then commodities, how long has it been since humans grew corn? But you'll see all this as we go through the learning outcome statements. Notice there's a lot of describe and explain. So this is what I was talking about with breadth, and then we will have to use our calculator at the end. So notice what we're doing here. We're going to look at hedge funds, private capital, natural resources, real estate, infrastructure, and then we're going to ask ourselves the questions that sound something like, all right, we're learning this topic, and it's a great standalone topic, but what it does, it provides us with an even greater foundation to understand risk and return and correlations back in the traditional framework that we've done in previous study sessions. All right, so let's start with this first one. Describe types and categories. All right, characteristics. Narrow specialization of investment managers. And so I always tell my students that I say, hey, look, if I'm a mutual fund manager and I say, hey, send me your money, I'm going to invest in these kinds of stocks. And there's probably going to be a universe of thousands of those from which to choose. But if I'm going to be a hedge fund manager, I'll say, send me your money and I'm going to pick this little slice of the economy or the allocation or a sector or whatever that is. So narrow specialization. And of course, that second teardrop point is one that you'll see whenever you watch somebody telling you about alternative investments. So what do we know about correlations? Correlations measure the magnitude and direction of a relationship between 2 variables, like asset returns. And what we find is that there's super low correlation between, something like real estate or commodities and the return on Amazon stock, let's say. Less regulation, that makes perfect sense, but that comes with a consequence of less transparency. And so the authors, at least in the beginning of this reading, tell us that because there's less transparency and because these markets are more narrow and because they're probably less regulated, that they probably don't quite have the liquidity that the New York Stock Exchange does, and they probably have pockets, maybe larger pockets of inefficiency. Remember, we talked about the efficient markets hypothesis and Eugene Fama, that stock markets are highly efficient. Remember, we did the semi-strong form and the weak form and the strong form. Well, here, there might be in this alternative investment universe larger pockets of inefficiency. And of course, all you have to do is go to Yahoo Finance and type in a company like Johnson & Johnson, and you can get the historical daily stock prices going back, thousands of years if J&J had been around that long, but not so with alternative investments. limited historical risk and return data. So we need to figure out how to manage those limitations. And then unique legal and tax considerations. That probably makes sense there. Higher fees. That's super important, especially when it comes to hedge funds. And then remember this conversation that we've always had about diversification, the value of diversification and correlation. Well, in this universe here, we can have concentrated portfolios so that if we can identify a pocket of inefficiency and we can uncover undervalued securities inside of that pocket, then we can concentrate there, and then maybe we can generate higher expected returns. And dare I say it, that perhaps with similar kinds of risk levels, and I'm not going to say it, but I'll go ahead and say it, maybe even lower risk levels. Maybe, probably not, but maybe. And then there are restrictions on redemptions as well. All right, categories. We'll go through these in more detail as we go through the slide deck. Hedge funds, I'm guessing you guys know what those are. Private capital, real estate, natural resources, infrastructure, which is super important here as we move into the 2020s, especially in the United States, but I'm guessing it's similar throughout the world, that we need to build better bridges and tunnels and roads and dams and energy sources as well. And then look down at the bottom, embedded circle point, other. These are tangible assets like fine wine, antique furniture, stamps. So think of those as maybe collectibles. I'm a voracious reader. Those of you who listen to my recordings know this. And every once in a while, I'll come across a store in which there's a wine cellar and somebody makes the comment, oh, we can't drink that wine. It's priceless. It's too expensive to drink. It would be a shame to drink all those. So tangible assets, think of those as collectibles as well. I had a student in my class the other day that had a Led Zeppelin t-shirt on. And I told the quick story that when I was rocking out to my XM radio on the way to school that morning, I heard the story of a Led Zeppelin concert t-shirt from the early 1970s. Sold for $10,000. So that sounds like an alternative investment, maybe not in the traditional sense of alternative investments, but it is collectible. And then intangible assets as well. So how do we do this? So here's the LOS that says, all right, what are we going to do? So we can have direct investing, in which we take our capital and we directly invest in, let's say, an apartment building or the Led Zeppelin t-shirt. So no management fees, flexibility, highest level of control. But then, of course, you need to kind of figure out and perform your due diligence. I'm not quite sure what kind of due diligence there is in researching a Led Zeppelin t-shirt, but clearly, if I go back here, there is due diligence for, let's say a forest, how many trees in that forest and how many 2x4s can we get out of that? And of course, when we're dealing with forests and natural resources, we always have to ask the question, what kind of an impact does it have on the earth and the climate? What else? Greater level of due diligence. All right, I just said that. Higher level of minimum capital required. That's true for things like private equity. Maybe not for the Led Zeppelin t-shirt. How about co-investment, where you can kind of combine direct and indirect investing? That means reduced management fees. And you can share that more active management with maybe somebody who is more experienced or more knowledgeable. I always go back to that term that I heard, I don't know how many years ago, and I use it regularly, knowledge base. And that just means, let's go out and figure out what all this stuff means and what it is. Disadvantages, though, then there's probably less control. And there might be this adverse selection bias in this indirect component because information is not, of course, uniformly spread between and among all types of investors. Adverse selection simply means that when you trade with somebody who has more information than you do, then you're probably going to lose every time. For example, suppose that I paid $10,000 for that t-shirt and all I saw was the person holding it up and I saw the front and I'm like, oh man, that's beautiful. Robert Plant, Stairway to Heaven. Let me put that shirt on. But I didn't think to turn it around, and in the back there's a giant hole back there. So How about investing in funds? All right, so fund managers offer investment services and expertise, lower level of investor involvement. So those make perfect sense. Access to alternative investments without having to know much about those alternative investments. And look at the, what is that? The fourth one down there, potentially valuable diversification benefits. Never, ever forget that for any of these kinds of securities in this asset class. Lower minimum capital requirements. I mean, that's generally true, but sometimes it's not. But what is a disadvantage is that there are all sorts of extra and costly management fees. I have an assignment in my investments class where in our trading lab we have the Morningstar software, and so I go through all those. We pick a mutual fund and we go through all that, and I always emphasize, the load and the no load, and then the expense ratio, and I always comment about the expense ratios. But for this alternative class in the fund universe, then those are probably fairly high. And then, of course, there are some performance fees, which we'll talk about in one of the last slides. So look at that last one. Investor must conduct thorough due diligence when selecting the right fund. And then, of course, there are investors out there with substantial capital that might want to look at a partnership structure. So we have a limited partnership where we have a whole bunch of limited partners, and then there's a general partner, and that's probably going to be the fund manager. So the GP runs the business and then incurs all of the liabilities. And so we, as the limited partners, we play a passive role. Of course, there's got to be some contract in there, so that's the limited partnership agreement. And then, of course, there can be side agreements as well. And we can do public-private partnerships, and that's probably, here, let me swing back here really quick. Do I have that written in here? No, that's in a later slide. No, there it is, infrastructure. So this public-private partnerships probably has a lot to do with infrastructure, because the government, whether it's the federal government or local governments, will say something like, hey, you know what, let's build a bigger bridge across that creek over there. And so the government probably doesn't have a construction company, but they probably will hire a construction company. So there's that partnership, and then you can have joint ventures as well. All right, how about an important one here, compensation structure. So management fees, you probably know all about that. This is called a base fee. But then there's a performance fee, which, for those of you who pay attention to politics, typically gets lots of front page news because there's a movement to kind of do away with this, or at least lessen the impact. But these are based on what are known as excess returns. And of course, those excess returns have to be based on some kind of a minimum rate of return. That's called a hurdle rate. And think of that hurdle rate in the exact same framework as we did way back when we did capital budgeting. And we called one of those rates of return in there a hurdle rate. There will also be consulting fees and monitoring fees, and there are some other definitions in there that you should probably know, catch-up clauses and high water marks and waterfalls, and you probably know all about those. Those are simple definitions. All right, let's get into the series of LOSs that asks us to explain some of these alternative investments. So characteristics of hedge funds. And so this is how I tell my students all the time. I say, if I'm a hedge fund manager, I'm going to say, I'm Jim. I'm going to say, send me your money. And I'm going to say something like, you know what, don't send me $3,000 like you can send to the popular mutual funds. Send me $1 million, or send me $5 million or $10 million. And by the way, when you send me that capital, I'm going to do a bunch of stuff with it, but you need to have an awareness that I'm not going to send you your money back tomorrow or the next week. So there are holding periods in there in which redemption is not possible. So if you can send me your money for 2 years or 5 years or maybe 20 years, I mean, that sounds like a long time, but then send me your money. And what I'm going to do is I'm going to invest however I want to. Now, of course, the however I want to doesn't include things like, I'm going to take it to the racetrack and bet it on horse number 6. Or I'm going to take your money and bet it on, boy, dare I say this again, for those of you who are football fans, Tom Brady winning another Super Bowl. But what I'm going to do is I'm going to I'm going to use your capital and I'm going to extend it into all sorts of traditional securities and non-traditional and alternative securities. And so look at that second arrow point, the purple one. Hedge funds are generally deemed riskier, creatively managed. And so look at the last part of that, taking long and short positions. And so part of what I'm probably going to do is I'm going to say, you know what, I really have done a lot of research on the retail industry. And I'm going to pick one big retail firm, let me just pick it and say Walmart, and then pick another one and say Target. And I'm going to say, boy, one of those is undervalued and one of those is undervalued. So I'm going to take a long position in one and a short position in the other, taking advantage of maybe a pocket of inefficiency inside of that industry, but then maybe trying to worm my way into some correlation strategic plan. All right, the goal, generate high returns, of course, either in absolute sense or on a risk-adjusted basis relative to portfolio level volatility. I'm always in favor of let's make sure that we have a benchmark out there. Hedge fund strategies, so equity, I talked about that with the correlation, long and short. Event-driven strategies, these are probably centered around firms that are likely to be acquiring firms or target firms in the merger and acquisition game. They're probably likely to be centered around bonds that are rated, let's say single C, so that we have this event-driven bankruptcy that may affect bond prices and stock prices. Relative value strategies. I mean, you can come up with almost any relative value comparison, maybe operating cash flow to stock price or something like that. And then a macro or CTA strategies. And these are interesting because, you take the macro environment and you're thinking, all right, I'm a macro analyst. And so I'm an expert on things like how does inflation and employment and housing starts and Fed activities, how does that impact the macro economy? And so I'm going to make a bet that whatever those input variables are, they're going to allow the economy to expand. And then I'm going to find investments inside there, whether they're traditional or alternative, to take advantage of that undervaluation. And then, of course, CTA, commodities. I mean, this is big news all the time. Oil prices, they go way down. Oil prices go way up. Private equity refers to investment in privately owned companies, or public companies with the intent to take them private. And so this probably involves debt. So we've got to talk about leveraged buyouts, and it probably involves some kind of venture capital. And I was interested in the way this reading handled the venture capital. Remember, I was telling you, we're going to do lots of breadth and not too much depth. The previous reading here, and I can't remember if it was the level 1 or level 2 reading, had pages and pages on venture capital. So here, this is probably all you need to know to answer a venture capital question here. So formative stage, this is the stage where, an entrepreneur has an idea but doesn't really have any money. So it spreads that idea around, and then other people come around and say, hey, that's a good idea. Here's $10 million. Have a great day. And then as the firm grows, you need some kind of other later stage financing. And this is where the capital structure on the right-hand side of the balance sheet becomes more and more interesting, and then mezzanine stage. And then, of course, growth capital, where you have minority interest. The next question then becomes, all right, how do we get out of private capital? So we do all of this, whether we have the leveraged buyout or growth or the venture capital, and then how do we kind of get our money back? Well, we sell it to a strategic buyer. We bring it to the public. Maybe we rearrange stuff on the right-hand side of the balance sheet. Let's call that recapitalization. Or we could sell it to somebody else, right? And then we could liquidate. So private debt categories, so direct lending, that makes sense. Mezzanine loans. So this is on the right-hand side of the balance sheet, of course. And so what this does is divide the bond. A lot of times candidates think of bond issues as being, just kind of one thing over there on the right-hand side of the balance sheet. But these mezzanine loans and even venture debt, have different categories. So some have to be junior, and then some have to be, or at least one has to be senior. And then you try to figure out which one comes first and which one comes second. and then distressed debt. I talked about that just a little bit briefly. Private equity funds may provide higher return opportunities. Yeah, that should make perfect sense. Once again, going back to my discussion on maybe not so much pockets of inefficiency, but pockets of less transparency. Maybe nobody knows about this company that has a crown jewel as an asset, and it's kind of hidden somewhere around maybe some of the other assets of the company. Natural resources, these are obvious notions here: commodities and land, farming and timber. Commodities can be standardized, of course, and this takes us right back to the commodity exchanges. I love telling the story about having my students see Trading Places with Dan Aykroyd and Eddie Murphy. Of course, they're trading orange juice futures contracts. And so that's the standardization of these commodities. And remember, there's tremendous liquidity on these organized exchanges and even the over-the-counter exchanges for commodities. And look at that third embedded circle point there. I just want to say this as a point of emphasis. Returns on commodity investments are based on changes in price. Maybe we could have put a comma there, changes in price, which has lots to do with inflation. That's why gold and oil have traditionally been referred to as inflation hedges. So if we have lots of inflation, then we're probably going to have increases in gold prices. Timberlands, not highly correlated with other asset classes. Farmlands provide a hedge against inflation. Portfolio diversification, inflation protection. Look at that last one here. That's probably true. Liquidity is very low. Maybe we could even put another very in there. Liquidity is very, very low. I mean, how many individuals, and then how much private equity and how much hedge funds and how much institutional investors are out there looking to buy a forest? Which then implies there's a risk of negative cash flow. And then we need to make certain that we embed our understanding of risk management to include weather events. All right, real estate. What did I say? What did I say in the very beginning here? That this goes back to when the earth was created. However you believe the earth was created. And so there was land, but I'm guessing, that 5 billion years ago, there wasn't any deed or any title to any of that land. But sooner or later, somebody figured out that, hey, I should probably own that land if I want to plant some corn on it or do whatever it is that I want to do on it. Competitive long-term total return. So this is important. You get income generation, of course, with the rent, and you get capital appreciation over time. But I want you to be careful here. Remember that the CFA Institute, they have never said, as long as I've been a part of this program, this is 20 years by now, I've never heard anybody say something like, oh, hey, we want to throw current events in there. But you can't think about real estate and not think about how COVID has impacted, apartments and rental agreements for strip malls and other kinds of commercial real estate. And so you think about how cool of a question this could be on the exam. It doesn't have anything to do with COVID, but the CFA Institute could say something like, hey, there's a virus out there and it's shutting down all sorts of components of the economy. What impact is this going to have on this particular alternative investment? Oh yeah, equity investing or debt investing, that's important. And so there's another arrow point, low correlations, of course. So here's a good illustration: forms of real estate investments, public or private. And this makes perfect sense. Go over to the public there for debt. I love talking about mortgage-backed securities. I'd like to spend the next 30 minutes talking about them and collateralized mortgage obligations and ETFs and how the Fed and the Fed's behavior is impacting those yields in those markets. How about characteristics of infrastructure? So think in the middle there. There's a bridge or a tunnel, and let's go straight up, right? Strategically important. And so this makes perfect sense that we have to build a bridge. So we're going to hire, a local or a regional or maybe a national construction company that knows how to build a bridge, right? There's about a mile of an interstate highway where I live, where they had to build a bridge and redo all this. And this was supposed to be done at the end of 3 years, and it's now almost 7 years later, and they're just now finishing. So that's strategically important. It relies on the ability of the government and the construction company to work together to achieve a common goal. There's a tendency for this to have monopoly characteristics. There's probably some regulation in there. But I like this one on the right, stable long-term cash flows. And of course, in order to get those stable long-term cash flows, you have to have a significant capital investment, probably right up front and maybe even in the future as well. So if there's long-term cash flows, then there's long operational lives, and that makes sense. And so there's defined risk, which of course includes things like weather. And I'll just go back to my example. I don't want to say incompetence, but I'll say something like, 3 years and 7 years. Those don't sound like the two entities were on the same page. And of course, there's probably lots of debt involved in this. Now, I really like this LOS, because what we can do is take this LOS and go back to what we learned about the Sharpe ratio and the Sortino ratio and apply it to alternative investments. Let me go ahead and just remind you, although note the LOS said describe, it doesn't say calculate, but the Sharpe ratio is going to be a ratio of the premium in the numerator, where we take the return on, let's just call it the alternative investment, minus some measure of a risk-free rate divided by the risk of that alternative investment. And of course, Sharpe defines risk as standard deviation. So that's why that first arrow point, we're told gauge the performance of an investment by adjusting for risk. We adjust for risk by dividing that in the denominator. So notice what we have in green there. Higher the Sharpe ratio, the better the investment, the better performance. So that makes sense. But here, this is key, that third one. The Sharpe ratio is based on a normal distribution. So note, we have return in the numerator and standard deviation in the denominator. So when you do returns, which is the first moment of the distribution, and you do standard deviation, which is the second moment of the distribution, you're automatically assuming that those first two moments capture all of the risk of that particular investment. But look at what we say there at the end of that sentence. Some investments, particularly alternative investment, may have the third moment of the distribution, which is skewness, and they might even have the fourth moment of the distribution, which is kurtosis. So that's a really, really good exam question. So what happens if a specific alternative investment exhibits skewness, the third moment of the distribution? Well, then you can just throw the Sharpe ratio out, or you can use the Sharpe ratio, but then you probably have to augment it with some other kinds of measures that include skewness. Sharpe ratio treats all volatility the same, because standard deviation of the Led Zeppelin t-shirt is comparable to the standard deviation of a bridge. So all volatility is treated the same. I mean, that could be a good thing, but it probably has some disadvantages as well. Sortino ratio, we take in the numerator a measure of performance, like the return on the alternative investment. And we'll go ahead and subtract out some risk-free rate of interest, but we're going to divide by just the standard deviation of the downside risk. So instead of computing standard deviation like we did in a previous study session, and what we'll do in future level 2 and level 3 study sessions, we're going to ignore all of those returns that exceed the mean. All we're going to do is compute that standard deviation for those returns that are less than the mean. So each additional return unit of downside risk. So it's downside deviation. And so what this does is add a little bit of more flavor to our performance evaluation. And in fact, the reading actually says something. Now I'm paraphrasing here, but the reading says, in some circumstances, the Sortino ratio is superior to the Sharpe ratio. So I'd probably remember that for a potential exam question. But of course, Sharpe and Sortino, they don't consider correlation, so there's a downfall. But here's what you should be asking then. As good financial analysts, you should say, okay, Jim, on that last page, on that last slide, you were telling us about standard deviation, but didn't the CFA Institute emphasize things like diversification, and that we eliminate a component of standard deviation through diversification, and all we're left with was beta? And so, of course, this is the Trainer ratio. Trainer ratio is the return on the alternative investment minus some measure of the risk-free rate divided by the measure of systematic risk of that particular investment, which is, of course, the beta. So the lower the beta, the higher the Trainer ratio, and the more attractive is the asset. So note that there's some implicit measure of correlation inside of the Trainer because we're reducing standard deviation to its one important component. So what are some other issues in performance appraisal? So variability in cash flows, especially in real estate and private equity, that's going to have an impact on the numerator of all of these ratios. And then, of course, there's super leverage in these alternative investment. That's going to magnify the returns, both positive and negative. Let's flip over to fund analysis. If we're looking at a hedge fund and we're trying to compare that to maybe private equity or maybe even a regular old mutual fund. And we know that the SEC has certain rules that mutual funds have to do this and this and this. But hedge funds, they might not be subject to the same kinds of rules. So frequency evaluation varies. So you might be able to get, clearly you can get an annual return on mutual funds, probably even a quarterly one, maybe even a monthly one. But for a hedge fund, you might not be able to get one for 2 or 5 or 10 years. And then liquidation always provides some kind of challenges. All right, how about custom fee arrangements? All right, hedge funds may charge different fees depending on the investor's liquidity, size, or any kind of an agent involvement. So, if I show up and say to a hedge fund manager, hey, here's $100 million and you can have it for 10 years. And you don't even have to call me for the next 10 years. Well, the fee is probably going to be a little bit different than if I only have $1 million and I want to call you every single day. Founder shares, this is probably important. Different rates of return for the first 100 million. And then there's an either or a fee. And so we can either do a management fee or an incentive fee. And of course, once again, when we do the incentive fee, we have to worry about the hurdle rate. So let's go ahead and get out our calculators. And I'm not even sure you need your calculators here, but this LOS does ask us to calculate. All right, so you ready? 100 million in AUM today. Fund grows to 120. So that's a good thing, right? And then it falls to 90. So that's not a good thing. And then it rises up to 140. So here we have 3 periods. And so the question then becomes, what's our return? And so even without a calculator, you should think to yourself, okay, we start with 100, we end with 140 at the end of 3 years. So there's a 40% holding period return. Now, of course, that holding period is 3 years. What we could do is we could go ahead and discount that back and get an annual holding period return. But that's really not what the motivation for this LOS is. So calculate and interpret returns. So let's go ahead and analyze the returns as they relate to the fees. All right, so let's look at that second diamond point. If the incentive fees are not calculated based net of management fee, the return is closest to, and we'll do the 2 and 20 fee structure with the high watermark provision. All right, so let's go ahead and work through the math here. So the end of period 1, fund growth, that's from 100 to 120. So there's 20 million, right? So that's 20%. So we know it's 20%. However, we need to subtract out those management fees. Remember in that example that we used way back, time value of money, if we're doing holding period returns and we receive interest payments or dividend payments, we kind of add that to the holding period return. But here, that 120 at the end of period 1 reflects all that reinvestment stuff. So we have to subtract out the management fee. So 2%, let me go back here. What is that? The 2 and 20. So we take 2% of the ending value, 120, make sure it's the ending value, not the 100 million. So that gets us 2.4. And then the incentive fee, we're going to take 20% of that 20 million in capital gain, let's say, or growth. So there's 4 million. So that gets us up to 6.4. So that eats into our $20 million gain. So our return to investors is just 13.6. So think about this. We have a 20%, 100 to 120. That sounds like a good thing, but then we have to pay the fund manager. So we're down to 13.6. All right, so what happens during period 2? We go from 120 down to 90. So there's a minus 30. Management's still going to take its fee, 20% of that ending value, 90 million. So there's the 1.8. No incentive fee, right? No incentive fee. So we haven't reached that high water point. And that high water point was established by the ending value at the end of time period 1. There's the 120. So we paid the 1.8 million. Management fee, no incentive fee. So our numerator, this is not good. We have a minus number there, and then we're gonna add another minus number. So there's a minus 30 minus the 1.8 divided by the beginning value again, of course. So there we lose 26.5%. Now what happens in time period 3? We go from 90 to 140, so there's 50 million. So this is really cool because what we've done is we've recovered our earlier losses, plus we've gotten over that high water mark of 120. So we need to figure out how all those fees kick in for that third year. So what's the good news? The good news is that we made $50 million. But we have to pay the management fee, so 2% of the ending value, so that's 2.8 million. And then we need to get our recent capital gain, so there's the 120 to the 140, there's the difference of 20 million over that high water point. And we're doing 20% of that $20 million, right? Let me go back here real quick. So there's the 2 and 20 fee structure. So 20% of that 20 million is 4 million. So if you sum those, we get 6.8 million. So we go from 90 to 140, that's 50 million, but we paid 6.8 million in fees over the 90 million. So there's a 48% return during year 3. So here's this 3-year holding period return that I was telling you about. We started with 100, we ended with 140. So there's the 40 in the numerator. So there's the 40%, right? But we have to subtract out all of those fees. So that's a 25% holding period return. That's a 3-year holding period return to investors. And that takes us through, lots of breadth and just a little bit of depth there. And so my emphasis would be on those 5 explains in the middle, because if you can explain those characteristics in the context of how each of those fits into the more traditional stock and bond and money market investments, I think you cover the overwhelming majority of these LOSs. And then don't forget to be able to calculate there at the bottom.